Life insurance sounds kind of complicated, right? But what if I told you that at its heart, it's actually a really simple promise? Well, that's what we're going to do today. We're going to break down exactly what that promise is, how it all works, and what it really means for your family's financial security. So, let's dive right in. So, let's just cut to the chase with the one question that really matters. Just think about it for a second. If your income just stopped tomorrow, what would happen? How would your family pay the mortgage, the car payment, the grocery bills? This isn't just some hypothetical question, you know? It's a real, practical problem. And that's the exact problem life insurance is built to solve.
And here's the beautiful thing about the solution. Life insurance is basically a tool that takes one of the biggest what-ifs in life, the financial chaos that can happen when someone passes away, and turns it into a definite. It creates certainty out of uncertainty. It's a promise of a clear, predictable chunk of cash, which gives your family the breathing room they absolutely need when they're going through the toughest of times.
Okay, so what does that financial protection actually do? I mean, beyond just cutting a check. It turns out a life insurance policy has a few really critical jobs. Let's break down the four main gigs it has. First up, you've got income replacement. This is the big one. It's about making sure the money keeps flowing so the day-to-day bills get paid. Then there's debt protection. Think about your mortgage. Wouldn't it be incredible if that was just gone? That's what this can do. Pay off the house so your family owns it, free and clear. Third, and this is huge, is avoiding forced decisions. This prevents your family from having to sell the house or the car in a panic just to raise cash. It gives them options. And finally, there's legacy planning. This is about leaving something behind, a financial gift that can help set up the next generation for success. All right, so how does this actually work? If you strip away all the jargon, a life insurance policy is really just a simple contract. It's an agreement with some very clear rules. It really boils down to this. Your side of the deal? Super simple. You pay the premiums, whether that's monthly, quarterly, or once a year, to keep the policy going. The insurance company's promise? It's just as straightforward. If you pass away while the policy is active, they promise to pay out that lump sum of cash, the death benefit, to the people you've chosen. That's it. It's a simple but incredibly powerful exchange. So let's see how that promise plays out in real life. It's a pretty logical four-step process. Step 1, you're paying your premiums, keeping everything active. Step 2, when the time comes, your family, your beneficiaries, they file a claim. It's usually a pretty simple form. Step 3, the insurance company does its due diligence, just verifies everything is in order. And boom, Step 4, the death benefit is paid out. The whole thing is designed to be as smooth as possible, to get money into the hands of your family right when they're at their most vulnerable. Okay, so now we get to the first big fork in the road. This is the first major decision you have to make. Pretty much every policy out there falls into one of two main buckets, and knowing the difference between them is absolutely key. I think the best way to wrap your head around this is to think renting versus owning. On one side, you have term life. Think of this like renting protection. It's simple, it's affordable, and it covers you for a specific chunk of time, say 10, 20, or 30 years. It's perfect for temporary needs, like while you're paying off a mortgage or raising kids. On the other side, you've got permanent life. This is more like owning your protection. It's designed to last your entire life, no matter what. The premiums are higher, for sure, but it comes with this really interesting extra feature, a savings part called cash value. So what in the world is this cash value thing? Well, imagine a savings account that's literally built inside your life insurance policy. That's kind of what it is. A piece of your higher premium payment gets funneled into this account, and it can grow over time tax-deferred, which is a nice perk. It creates this pot of money that you can actually tap into later in life if you need to, using loans or withdrawals. Now here's the catch, and it's an important one. If you use that cash, it can reduce the final payout that goes to your family. So it's a really flexible, powerful tool, but you've got to use it wisely. All right, let's talk about the money. How is your premium actually priced? I mean, have you ever wondered why you and your friend, both the same age, could get completely different quotes for the exact same coverage? Well, the answer is a process called underwriting. It's basically how the insurance company figures out your personal risk level. Yeah, this question really nails it. It all comes down to one word: risk. The insurance company is basically a professional risk calculator. They're trying to figure out the odds that they'll have to pay out a claim, and they set your price based on that calculation. And so, what are they looking at? Well, here are the big ones. Of course, your age and your current health. Those are the heavy hitters. But they also dig into your height and weight, your family's medical history, and your lifestyle. You know, do you smoke? That's a huge one. They even look at your job and hobbies. Are you a skydiver or a desk jockey? All of these things get crunched together to create your risk profile. And the rule of thumb is super simple. The healthier and less risky you are, the less you're going to pay. Now, this right here is probably one of the most awesome benefits of life insurance. Listen to this. Once your policy is approved and your rate is set, it's locked in. For most policies, that rate won't change, even if your health gets worse down the road. This is a huge deal, and it's exactly why so many people get coverage when they're young and healthy to lock in those super low rates for the long haul. Okay, let's bring this home. We've talked about how it works. Now let's talk about building your plan. This all leads to the million-dollar question, right? How much life insurance do you actually need? So, you've probably heard this rule of thumb before. People will say you need about 10 to 15 times your annual income in coverage. And you know what? As a quick back-of-the-napkin calculation, it's not a bad place to start. But that's all it is, a starting point. It's definitely not the whole picture. If you want to get more precise, the best way to think about it is to find the gap. Here's how you do it. First, you add up all the money your family would need. Think big: the mortgage, any other debts, college for the kids, and just everyday living expenses for years to come. Then you subtract what they already have: your savings, investments, any existing insurance. Whatever is left over, that's the gap. And that's the job your life insurance needs to do. And that really brings us to the final and maybe most important question you can ask yourself. Life insurance isn't really just about buying a product. It's about stress testing your entire financial plan. It's asking, is the plan I've built for my family strong enough to hold up during one of the worst things that could possibly happen? At the end of the day, that's what it's all about: building a rock-solid foundation of certainty in a world that is anything but.